and tax and tax resolution and representation. Rich has been an enrolled agent since 2011. He is a fellow of the National Tax Practice Institute, as well as a member of the National Association of Enrolled Agents and National Association of Tax Professionals. Rich understands that tax professionals and financial advisors rarely talk during the year regarding the tax consequences of trades or other investment decisions. And as a result, the client is presented with the unexpected tax bill at the end of the year. As an enrolled agent and registered investment advisor, he has the knowledge and skills to suggest and implement strategies that can save clients thousands of dollars under tax bill. Rich is also a past president of the Brentwood Rotary Club. He enjoys cycling, golf, and volunteering in the Brentwood community. So Rich, take it away.
All right, thanks. Thanks for having me today. Ro gave me a list of topics to discuss today. So do you want to just kind of go down the list and hit those point by point? That work?
Yeah, we'll go point by point, and then afterwards we'll have questions and answers.
Okay, so the first topic you wanted me to talk about was entity selection and the tax implications of each. So the very basic entity would be a sole proprietor. You report your income and expenses on your 1040 Schedule C. Your net income is subject to what we call the self-employment tax, which is Social Security and Medicare. It's about 15.3% roughly. And, you know, for all of these entities, I'll just say the expenses, the deductibility of expenses really doesn't change from entity. It's the IRS defines a business expense if it's ordinary and necessary within your particular field. So when I talk about these, there's not necessarily, there are some advantages to being a corporation, but for the most part, any expense that you can take as a sole proprietor, you can take on a business return and vice versa. So the sole proprietor, there's nothing special you need to do. You can file it under your name. If you want to get a fictitious business statement, you can certainly do that, but it just gets reported on your personal return. The next entity that you may or may not be familiar with is an LLC. The LLC is actually not recognized by the IRS. This is a state construct. And depending on how many members are in an LLC and how it's structured, it can be taxed in various ways. If you are a single member LLC, you have a couple of different options. If it's just you and you choose not to make any other election, it's treated as what the IRS calls a disregarded entity. And the income and expenses, at least on the federal side, will be reported on Schedule C, just like you would as a sole proprietor. The only difference with the LLC in California is you are required to file Form 568, which is the California LLC form. So there is actually a separate form for an LLC in California. Your other options, if you're single member LLC, are to elect to be taxed as an SCorp. And if you make that election, for all intents and purposes, the IRS will treat you as an SCorp. And I'll kind of explain that in a few minutes. The other option is to be taxed as a C corporation. In the case of a single member LLC being taxed as an SCorp, an S corporation, and I'll touch on this a little bit later, but it's a flow-through entity, meaning that the return that you file with the IRS is actually an informational return only. There is no federal tax on an S Corp return. All of that information flows through to your personal return via the Form K-1. And so you would report your share of income, losses, expenses on your personal return Schedule E. If you elect to be taxed as a C Corp, C corporations are not passed through. They pay tax on whatever their income or loss is on that form, and there's a separate tax structure for a Schedule C. And I'll again, I'll touch on Schedule C in just a few minutes. So those are your three options as a single member LLC. You can elect to be a disregarded entity and file on Schedule C. You can elect to be taxed as an S-Corp or a C-Corp. And those elections can be changed. You're not locked into that particular election if things change. The benefit to the LLC is not so much in not necessarily saving taxes, but the fact is the LLC provides you an extra layer of protection against lawsuits, that sort of thing, because you can segregate out your business in an LLC from your personal assets. So as long as the rules are followed, it's like a corporation, you have that quote veil around. Its protection's not quite as good as a corporation, but it does provide you an extra layer in case you're sued. So that's okay. So now we get into a multi-member LLC. So that's 2, 3, 4, 5, however many people associated with that. There, your options are a little different. If you are a multi-member LLC and elect not to make an election, then you are treated as a partnership for tax purposes. So on your, so you would file a partnership return, Form 1065. The income and expenses would again flow through to your personal return via, or the income or loss would flow through to your personal return via Form K-1. A multi-member LLC also has the same option to elect to be treated as an S-Corp or a C-Corp. So there's some flexibility with the LLC. The other nice thing about the LLC, if you do elect to be taxed as an S-Corp, even though you're being taxed as an S-Corp, the responsibilities as far as what forms need to be filed and what protocols need to be filed with an LLC are less strict than they are with an S-Corp. So an LLC taxed as an S-Corp has a little more flexibility and not quite as many protocols to follow than just incorporating as a corporation. And I can go a little bit deeper, probably not relevant for this one, but if anybody has any questions on any of this, obviously you can contact me. So as already mentioned, the second type of entity, or I guess in this case, the third type is an S corporation. So when you incorporate, you file the articles of incorporation in whatever state you're in. Most of us will be California. And this is a question I get asked a lot of time. What's the best place to incorporate? Should I incorporate in Nevada? Should I incorporate in Delaware? And honestly, in California, if you are a foreign corporation, you still have to register in California as a foreign corporation and pay taxes just as if you were a local corporation. So in most cases, you're not going to save anything by forming an out-of-state corporation, because it's still going to be registered in California. You're still going to file your California tax return. But again, if you have any questions about that, talk to an attorney. They're the ones who will set up. I don't do the incorporation myself, but so if you're looking to do something like a multi-state thing, again, that's a little different. But if you are in business in California and you do file for a corporation in another state, you still have to register in California. So when you incorporate, by default, you're a C corporation. If you want to be taxed as an S corp, you need to make an election to say, hey, I want to be treated as an S corp. So what's the difference? Again, an S corp is a flow-through entity, meaning net income, net losses will flow through to your personal return via Form K-1. The federal S corp does not pay any taxes federally. It's just an informational return. And I will go back up just a second. An S corp and an LLC and a C corp. Actually, I'm going to touch on the LLC and S corp because those are two pass-through entities. For California only, there is a minimum $800 franchise fee. And if you make a certain amount of income over and above the threshold, then there is taxes paid to California for a corporation. Just California, not federal. As an S corp, you are most of you will be 100%, maybe 50% shareholders if you are actively working in the business on an SCorp. And there is a question here, can you discuss the benefits versus disadvantages of each? Yeah, I'll touch on that a little bit. I'm just kind of explaining the different entities. As if you're a shareholder in SCorp working in the SCorp, you are required by the IRS to take what's called a reasonable salary. And one of the bullet points we'll talk about is how do I pay myself a reasonable salary? So I'll touch on that in a few minutes. But you're required to pay yourself a salary, and you file your return on a Form 1120S. And trying to think what else. Again, I think the important thing takeaway there is that it is a pass-through entity. So the entity itself doesn't pay taxes other than California. The last type of corporation for our purpose is going to be a C corporation. A C corporation is basically a self-contained entity, meaning it's not a pass-through. So any income, net expenses, the entity itself will pay the tax. So it doesn't flow through to your personal return. Again, with a C Corp, as an officer working in the company, you are required to pay yourself a salary. So there will be a W-2 issued, but the corporation itself pays tax on any profit. Right now, the corporate tax rate is, I think it's 21%, at least through 2025. Congress, depending on who's in power, keeps threatening to change that. They think one side thinks it's too low. Again, I don't want to get into the politics of all that, but that is subject to change. But right now, the tax rate's fairly low. The advantages of being an LLC not taxed as a corporation is the protection you get from being an LLC. It's just basically the liability protection. If you're a single member LLC or a multi-member LLC taxed as a partnership, there really are no tax advantages because that income on the K-1 is going to be subject to self-employment taxes. So if you make 100,000, it's going to flow through to your personal return. You're going to pay the Social Security and Medicare tax on that 100,000, just as you would if you were a sole proprietor. So again, as an LLC taxed as you're a single member LLC, multi-member tax as partnership, there really aren't any tax benefits. You're just getting the extra liability protection. If you are an LLC taxed as an SCorp or an SCorp itself, your benefit there is that any profits over and above your salary and the expenses, those are going to be taxed as regular income, meaning you're not going to pay the 15.3% on that. So if you, after taking your salary, all the expenses, you're left with $50,000. That $50,000 is going to flow through to your personal return. You are not going to pay the 15.3% tax on that. So there are some tax savings there. There's other advantages with an SCorp as far as how SEP IRAs, 401ks get treated. If you're a single member LLC or if you're a sole proprietor, the amounts that you take to put into a retirement plan are still subject to self-employment tax. Whereas if you do that through a corporation, those are not subject to self-employment tax. So there's a little bit of savings there. Yeah, and that's, I mean, in a nutshell, those are kind of the differences. Again, there may be some additional, but for our purpose, I think today, that's probably a good way to look at it. A C Corp, there are some advantages, there's some big disadvantages too, and this can get pretty technical as far as the descriptions, but as a C corporation, if you have, let's say at the end of the day, you've got 100,000 profit in a C Corp, the C corporation is going to pay tax on that. But if you want to access that as a shareholder, you've got to issue a dividend. And so I don't know if you guys have heard the term double taxation on a C-Corp, but that's where this comes in. You're going to pay tax on the profit, which would be, again, let's use 100,000 for purposes. And then if you decide to, so the corporation's paid tax on that 100,000. If you decide to distribute that 100,000 as a dividend, then you're going to have a $100,000 dividend on your personal return, and you're going to pay tax on that as well. So those are probably not sure what else I can say about those. Again, this discussion can get pretty in depth, and if you guys are thinking about going one way or the other, it's good to talk to your tax professional. Is incorporating right for me? That is not something that I can address on a global scale. When I meet with my clients, I take them through a planning process to see if it makes sense, because when you incorporate, you are taking on some additional responsibility. You've got a separate tax return, which generally SCorp, CCorp, probably you're looking at about $1,500 to do that return, maybe more depending on the complexity. You've got the minimum $800 fee to California. You do have record keeping that's involved that is not required for a sole proprietor. So it really, again, when I'm looking at tax planning and seeing if somebody's incorporated, it really depends on, can I save you money on your taxes and how much? Because you've got to factor in all those different, like I said, you've got to factor in the cost of the the separate tax return, the cost of California filing in California. How much does it cost to incorporate? Are you able to pay yourself a reasonable salary and have a profit left over? I mean, there's a whole bunch that goes into this. And when I'm looking at a C Corp, I'm looking at the 20%, first of all, over and above your salary, do you need to pull money out of that corporation? What is your salary? If you do need to pull money out, does the cost of the dividend plus the 20% that you're going to pay in corporate tax, is that really going to save you money? So I mean, there's a lot of complexity that goes into figuring out which entity you should or should not be. And so it's an individual decision, and it's based on facts and circumstances. And so when I do have someone come into me and said, hey, should I incorporate? Then I'll take them through a process to find out, does this make sense? So again, there's no right or wrong answer. It really depends on individual circumstances. How do I pay myself a reasonable salary? Good question. Again, it's not an easy answer. The IRS only requires that you pay yourself a reasonable salary. Beyond that, they do not define what a reasonable salary is. Now, we can make some generalizations. If somebody is an S-Corp and they have $500,000 profit and they're taking $20,000 in W-2 income, IRS is going to look at that and say, okay, number one, no CEO in the world is going to pay themselves $20,000. It just doesn't happen. And then that $500,000 profit is not being subject to self-employment taxes. IRS doesn't like that. So in that case, you're looking at what would be called kind of a tax avoidance scheme. So the idea is to balance your salary so that you're taking a reasonable, but not too much, because again, you don't want to pay more in self-employment taxes. You have to, or in this case, Social Security, Medicare, but you also don't want the IRS on you. And so when I meet with a client to determine what a reasonable salary is, I take them through an extensive questionnaire that looks at a number of different factors as to how they're doing their business. If you're just looking for a quick and dirty solution, then there's various websites, and I forget what they are right now, but basically they'll do a salary survey. And if you take the average of what in this case, a realtor is paid in California, you're probably okay taking that as a reasonable salary. And again, I can't remember what the websites are, but there are websites out there that do salary surveys that you can go and look at, say how much, if you're hiring an admin, how much should I pay my admin? You can go out and look at how much an admin typically gets paid and use that as a, I'm sorry about that. So yeah, that again, that one's tough. And again, it comes down to facts and circumstances. And so, like I said, if you're just looking for a kind of quick and dirty answer, go out and find out what the average salary is for your position, and you more than likely can get away with that. Is the IRS generally isn't going to come bother you. Okay, John Strickland saying in the comments, Glassdoor, and that's probably a good one. And Allie, if you can type in there, do you have any specific questions about the advantages and disadvantages, or did I cover that okay?
We can unmute Allie. Hang on, let me unmute her so that she can ask her questions.
Okay. And if you just want to pop it in chat.
That was fine. I appreciate it. Thank you.
Okay. If you want to go in depth, you can always call me at a later time.
Okay, perfect.
Yeah. All right, so next one, can I rent back my in-home office to myself? I'm assuming that you're talking about if you are a corporation and you have a home office. Quick answer is yes. It gets a little more complicated, but yes, it can be done. Probably not much more I want to say about that in this case, which make a whole lot of sense. Okay, we already talked about, can I incorporate in a different state to save money? No, if you're in California doing business in California, you do have to register as a foreign. If you're incorporated out of the state, you do have to register as a foreign corporation in California, and they're going to treat you like any other corporation. This one, and maybe Ro, you can kind of talk about this. The difference between an LLC, a trust, and an insurance policy, those are kind of three different things. I'm not sure how they relate. Did you have a specific thought on that question, or did that come from someone?
It came from someone else. Most of the questions I asked of you came from other people.
Okay. If you're on the call and have some questions about that specifically, just let me know. But as far as an LLC is a business entity, a trust is a legal document, and obviously an insurance policy is to cover some hazard, whether it's life, whether it's liability, etc. Changes in the tax code for 2021, 2022. Not a whole lot to cover there. If you have kids, you may have received what's called the advanced child tax credit, where the federal government, instead of waiting for your tax return to compute the child tax credit, you may have received some payments ahead of time. You should have, if you haven't already, you should receive a document from the federal government that shows how much of that advanced tax credit you received and how many children that was based on. Your tax preparer will need that information. There was a $1,400 stimulus payment that went out. If you're not sure if you got that, you can go to the IRS website, and they do have a portal where you can check on all of your stimulus payments. And if for some reason you did not get that stimulus in 2021, it will, if you're eligible, show up as a credit on your 2021 tax return. So if you didn't receive it, doesn't necessarily mean that you won't. It just means for whatever reason, maybe in 2020, your income was too high. And I just had this happen with a client of mine today, where 2020, they weren't eligible to receive the stimulus payment, but their income dropped dramatically for 2021. And so they were able to recapture that. Other changes, if you are a corporation, the IRS is now requiring a new form called the 7203, where they are going to start tracking your basis in your corporation and your shares. That form is not available yet. I think in most cases, it's probably coming out in March. Why that's important is, if you have a loss, and let's just use an SCorp as an example, if you have a loss on an SCorp, say of $50,000, and your basis in your shares is only $25,000, you can only deduct $25,000 as a loss. It depends on your basis. And what'll happen, you'll deduct a $25,000 loss, your basis will drop to zero, and then the extra 25,000 will carry forward until you do establish basis. So let's say the next year you have a profit of 25,000, you can use that excess $25,000 loss carryover against the current year's income. So if your tax preparer does ask you that and you don't know that information, you'll have to go back and calculate that based on all of your previous returns. And hopefully your tax professional can walk you through that. But that is something that's new for on the 2021 tax return. Off the top of my head, I can't really think of anything else. You may or may not have seen on Facebook, there was a kind of a controversy. There are two new forms for corporations, K2 and K3. I think they're 29 and 30 pages respectively. Those really apply if you have foreign income, foreign taxes paid, etc. The IRS was requiring that for everybody over a certain threshold. In the tax preparer community, it raised an uproar. We pushed back, and they've kind of they pulled back on that a little bit. But there are, in most cases, I think everyone here, I don't think it's going to apply to you, but just be aware that there is, if your tax preparer asks you for that information, that may or may not apply, but in most cases it shouldn't, since the IRS pulled back on this rule. It was something they put in at the last minute that was not covered during their public comment period and was going to cause chaos. So if you run into that and have any questions, let me know, but most of you probably shouldn't. Oh, let's see, mistakes that self-employed / realtors make. I think I touched upon this last time, but probably the biggest issue is not making estimated tax payments. I see this over and over again where no money is put aside, and especially for people that are just coming into the business and maybe have never dealt with Schedule C before. Let's say you net $100,000, you're going to have right off the bat $15,000 in self-employment tax plus whatever the income tax on 100,000 is, called 20,000. So you're probably looking about a $25,000 tax bill. Most people, first time, they're just kind of getting on their feet. They're trying to cover their expenses. They don't put that money aside, and it builds year after year. And so I've had to deal with some realtor clients, and actually other clients as well that aren't necessarily realtors, but they'll accumulate $200,000-300,000 in tax liability because they just keep getting further behind. Meaning they're trying to pay off this $25,000, they don't have enough to make the estimated payments, and it just snowballs on itself. And so figure for every sale that you make, your net commission, you're probably going to want to hold back 25%, maybe 30% between federal and California taxes. And that way, when you get to the end of the year, and what really you should be doing is working with your tax professional on a quarterly basis, looking at what your income, your net income is, because your expenses are also going to play a part in that. But you're going to want to meet on a quarterly basis with your tax person and figure out, okay, I've made this much net, how much should I pay in? And by making the quarterly payments, you're making smaller payments throughout the year instead of having to come up with a lump sum at the end of the year. And it's easier to keep track of. Okay, since I'm on the subject, Allie put in a question, can you discuss quarterly tax payments? Should we elect to do that rather than yearly? The law requires that you do make quarterly estimates. Now, if you don't, there's they're not going to come after you. What's going to happen is you're going to pay a penalty at the end of the year. If you've made a profit, it's called an underpayment penalty. Now, a lot of people, you know, it could be $100, could be $200, could be $50. A lot of people say, you know what, I don't care about the $50. It's too much trouble to make quarterly estimates. And if they've saved enough to cover it, you know, that's fine. Again, the IRS isn't going to come down on you for not making the quarterly estimates, unless you're one of those that, you know, keeps year after year accumulating more and more debt. But the law does require you make those estimated payments. As long as you do that, again, it's easier to make smaller payments 4 times a year than 1 time, and you'll save yourself whatever that underpayment penalty is. Okay, Melody has a question regarding putting rental properties into an LLC. Is this necessary if there's a good insurance policy in place? Again, it depends. I think if you've got one property and you have good liability insurance, there's probably not much of a benefit. Where I kind of see it coming into play is either you have multiple properties, and maybe you've gone in as a partnership with other people. So, you know, property one, you've got yourself and, you know, partner A, and then you've got another property that's yourself and it's partner B. You'll probably want to segregate those into separate LLCs. So for each property, you would have an LLC. It's going to protect the one property from if something happens from affecting your others. It's also a strategy you can use if it's just you that owns multiple LLCs. If you're concerned about liability, if they're in separate LLCs, they're protected from each other, meaning the investor, whoever's suing you can only go after that particular property. They're not able to come after all the properties together. So again, I think if you've got a single rental property, in most cases, an LLC is not needed. I think if you've got a good liability policy, that's fine. So Glenn's asking, are there any tax strategies that we as real estate being self-employed should consider doing? Yeah, depending on where you're at, there are a number of strategies. I mean, I've got a list of probably 20 or 30 that I can look at when I'm dealing with a particular client. Again, it just depends on the individual situation. I think Glenn lists an HSA as an example. Yeah, that's definitely a potential strategy. You know, again, when I'm looking at what I'm doing for clients, typically my planning clients, I'll have anywhere from 5 to 7 to 8 strategies that we can implement. So again, it depends on the individual, where they're at, where they're looking to go. So, you know, again, like you said, in a SEP IRA or a solo 401k, if you're a sole proprietor, those are certainly something that if you've got the excess cash flow looking to do, it'll save you, you know, it'll definitely save you on taxes. So again, it's probably too much, and that's a conversation we'll have with clients. It can be an hour or 2 hours as we look at different strategies. So, you know, if anybody has any individual questions on that, I can certainly touch upon that. Okay, so Virginia says, where can we max out our spending for real estate activities? Yeah, it's kind of one of those funny things where, you know, people always, what can I deduct? And generally the purpose is to make money. So if you have an expense that's absolutely necessary, then, you know, I would say go ahead and do it. If there are strategies that will save you on taxes, you can do that. Generally, expenses are, yes, they're a deduction, but when you spend that money, it's going to reduce your net profit. So when she's looking at, you know, promotions, open houses, absolutely. If it's ordinary and necessary in your business to attract clients or to, you know, close a property, absolutely. Well, she mentions in there percentage of client closing gifts. The IRS limits gifts to $25 per client. So I know that your closing gifts sometimes run in hundreds of dollars. You're only able to legally deduct $25 of that closing gift. Dining, you can take clients out to dinner and deduct 50% of that meal, as long as there is a business discussion or expectation of business being done. So if you are, clients, generally that's the case. If you're wining and dining let's say lenders are wining and dining realtors trying to get the business, that's certainly a legitimate deduction for meal, because you are discussing business and trying to establish those relationships. Postage, advertising, your fees to DAR, CAR, NAR, those are all deductible. Lock boxes, signs, your liability insurance, your education, all of those things are ordinary and necessary and can be deducted. But again, I think if you look at trying to reduce your tax burden, again, I would say that if you're properly planning and putting the money aside, you're probably going to pay about 30 cents on each dollar, depending on what your profit is. If you put that money aside, you're still taking 70% of that home. If you're looking to spend more money to reduce that, just to reduce your taxes, I say you're better off putting that 30% aside to pay the taxes and keep the excess rather than spending that. So again, it all comes down to planning. What are you looking to accomplish? Okay, so Allie's asking, when it comes to mileage deduction, what's the best way to track? So the IRS gives you two options when deducting transportation. You can either take actual expenses to the extent that the car is used for business purposes. So that would be things like gas, oil changes, repairs, maintenance. And let's say that you use your car 75% for business, so that you can take 75% of the gas receipts, 75% of the repairs as a deduction. The other option is to take mileage, which again, if you're 75% using your car 75% for business and you've got 100,000 miles, 75,000 miles of those would be eligible for, so again, it's 75% of the total miles driven. When it comes to mileage versus actual expenses, again, that's one of those where you kind of have to look at each individual circumstance to see which is the best. When the IRS sets the mileage rate for the year, they are taking into account things like the price of gas, the area in which you're living, the depreciation costs, the expense to purchase the car. They're factoring all that into that mileage rate. It's obviously, in most cases, it's easier to track mileage. There are apps out there that track mileage. I use one called Mile IQ. There's several others out there where every time you go on a business trip, you just punch in the numbers in your phone. Actually, it'll track your drive for you, and then you just classify it. And at the end of the year, it'll produce a report for you. When it comes to how specific do you need to be, I have represented realtors in audits where the IRS was trying to disallow the mileage for the realtor because they didn't have, quote, a mileage log. Now, the IRS regulations don't specify what that mileage log looks like. And so what we did is we took every listing that she had, every listing appointment, every open house, so we could track to the mile exactly how much mileage should have been taken. And the IRS tried to deny it, and I argued it, and they didn't have a case to stand on. So we actually got that mileage accepted. So there's not necessarily a format that the log needs to be in, as long as you know, if you've got your effect, in this case, we had a calendar with every listing appointment, every open house, and we matched that up to the actual listings that she had. And so we were able to substantiate that. So there's a number of ways to do it. But if you just say, you know, well, I think I use it 80%, and you do get into an audit, you're going to want to have something to back up those numbers. So, which is why these mileage tracking apps are awesome, because they're really, you know, if you can match up this drive to a particular address, and you've got that address as a listing, there's nothing IRS can do to challenge that. So it's generally, and that's how I'd look at it. You do want to have records just in case you're in an audit. Let's see. When interviewing an income tax specialist, what questions should we ask? I'm obviously a little bit biased in this one, but depending on the complexity of your returns, you know, how long have you been in business? Do you have a designation such as an enrolled agent or CPA? If you are looking at a CPA, find out if they specialize in tax. Not all of them do. Most of them are pretty good, but there are some CPAs that focus in other areas and occasionally prepare tax returns. When you're dealing with an enrolled agent, our requirements are 30 hours of tax education per year minimum. CPAs and EAs are licensed to do taxes in all 50 states. So it's a federal designation, whereas CPAs, they have to be licensed in the state in which they're preparing returns. And I would ask, you know, if it's a CPA, you know, how many hours of tax education do you take every year? Because you want somebody that's going to stay current on tax laws. You know, again, depending on the complexity of return, maybe find out, you know, what types of businesses do they deal with? How long have you been in business? Probably the same things you would ask if you were looking for a realtor. You know, how much experience do you have? And, you know, those sorts of things. If I think of any more, I'll let you know, but it's just kind of like an interview for anything else. Let's see. So a question here, but 39% of gross commission I get into a separate bank account immediately upon getting paid. The money is untouchable except for paying quarterly taxes and funding an IRA. Yeah, exactly. Perfect example is to put the money aside somewhere where you can't touch it, use it to pay the quarterlies. And if you want to fund the IRA, it's a perfect way to do it. And again, your tax preparer should be helping you with those quarterly estimates if you're interested. Now, I do have clients out there that really don't care, don't want to deal with quarterlies. I'm like, you know what, that's fine. Just be prepared at the end of the year. So if they want to put that into a bank account as opposed to paying it quarterly, I'm not going to argue with them as long as they don't mind paying that underpayment penalty. Oh, what might trigger an audit? You know, probably the biggest thing that triggers an audit is mismatching of information that gets reported to the IRS. So your broker is going to issue you a 1099 each year reporting how much your commissions were. And let's say that your commissions were 50,000 and you report your net income as 40,000. That's going to raise questions because the IRS already knows that you made 50,000 commissions. So why are you listing 40,000 as your income? Same thing with, you guys probably don't deal with credit cards. There's for merchants, there's a 1099K that's now being reported. And if your gross income is less than stated on the 1099K, that can trigger an audit. Excessive mileage is one that can do it. I couldn't tell you necessarily what's excessive, but I think if you had, you know, say maybe 5,000 miles last year and all of a sudden you've got 50,000, that might trigger an audit. They may want to know why your mileage increased significantly. Same goes for any other expense. If it's kind of out of line for what they see with the profession, so in real estate, again, if you've got $5,000-$10,000 in gifts, probably going to raise some questions. So I would, again, I don't know that they're not necessarily anything specific. Sometimes it's just bad luck, but as long as your expenses are in line with averages, maybe a little bit over, a little bit under, it's generally not going to cause a problem. But I would say the biggest thing is just mismatching what the IRS has on file for you. So every 1099, every 1098, every W-2 gets reported to the IRS. And when you file your return electronically, they have a program that matches all that information. So just make sure that's accurate. I'll tell you the one realtor that triggered the audit, before they came to me, they were using a tax preparer, and the initial return, they reported the income without any expenses. And then they went back and amended the return and added the expenses, and those looked a little bit funny. There was some weird stuff going on. And so the year they came to me, they got audited for the year before. So that's where I went through all this. But again, it's, amending a return is not a trigger unless there's really something odd about that. In this case, again, not taking any expenses and then coming back and, adding a whole bunch in. So in most cases, it's just, there's usually something, and again, it could just be a random audit, although those don't happen so much because the IRS is overwhelmed right now and they just don't have the auditors out there. So as long as your expenses are in line with kind of the norms, you're not going to have any issues. Trying to remember it's been a while since I've had to do a full-blown audit. Usually what you'll get is a letter in the mail saying, hey, you reported on this on your return. This is what we have in our records. Why the difference? And then we either say, oh, we screwed up, or, we explain, here's why we did this. It's called a correspondence audit. It's just a letter that comes through the mail. And those are the most common these days. So they're targeting something specific. Okay, when we have to prepare something at home, we are listing or staging the house. Is the tax different amount? No, if you're taking money out of your pocket to stage the home, or if you're taking it to repair something and you're not being reimbursed, those are typical business deductions that you can claim. It's not taxed any different. It just is a deduction for you. Now on the back end, if you make more money because of, if you sell the house at a higher than asking, it's just going to be reflected in your commission, but you're still going to be able to take that as a deduction. The last one was regarding loan forgiveness. What are the tax implications? In the case of a PPP loan, as long as you qualify, those were the paycheck protection programs. As a sole proprietor, you may or may not have applied for those. If you're a corporation, again, it depends on the circumstances. Generally, if you meet the qualifications for forgiveness, then you do not need to report that as income. California had a little bit of a different requirement for forgiving those, but essentially that was just a tax-free loan. And as long as you met the qualifications, there were no implications. If it's any other type of loan and you default on it, typically the amount that is forgiven is going to be considered income. So if you have a $50,000 loan that you default on, company will issue a 1099-C for cancellation of debt. That $50,000 gets reported as income on your return. That's generally how that works. I don't know that there's anything else really that, those are kind of the basic two. And usually, I really haven't seen too many business loans being forgiven, but Yeah, with the PPP loan, different story. So if you don't qualify for forgiveness of the PPP loan, you're required to pay it back over, I forget what the number of years is, it's 10 years, whatever it is, a very low interest rate. You can deduct the interest on that loan because it is a business expense. And, again, that might be one instance where if you default on that loan, that it may come back and bite you as income. I think that's all I had on the list. I'll open it up for questions now. I know some of you have been putting in the chat, but if you have specific questions, let me know.
You can either raise your hand on the reactions button or request to unmute yourself and we'll call on you.
Yep. Looks like Glenn has his hand raised.
Hey, Rich, it's Glenn.
Hey, Glenn.
Hey, you had talked about triggers for audits if your 1099 amount is greater than what you report on your tax return, which makes complete sense.
Mhm.
I don't believe the opposite is true though, right? If you, let's say my broker 1099 was $100,000, but I had other real estate related income, so I reported $105,000. That's not a trigger, is it?
No, it really isn't. In fact, when I first started, I would enter in every single 1099, and it just, I had some clients that had 20 or 30 of them. It just took forever. And so what I've kind of started doing is just adding them all up and make sure that the net income or the gross income equals or exceeds. And I've never had the IRS come back and question that. It's only when you underreport.
Okay. And another unrelated question to that, as I put in the chat, I just learned about HSAs literally yesterday, actually. And I was a little disappointed I didn't know about them because they look like a really good program. Is there any downside to using an HSA other than tying up money that you may not need immediately?
No, not really. I actually use one myself. They're great. I mean, basically it's money that you put into an account. You're limited if it's a family or individual account. And for the life of me right now, I can't remember the amounts that you can put in. I think it's for an individual, I think it's like maybe $3,500. So you can put away $3,500. It's a tax deduction. And when you use that money to purchase prescriptions, co-pays, any qualified medical expense, you're basically getting those at pre-tax, using pre-tax dollars.
Yeah, the other thing I like, it's $7,200 for a couple. And because I'm an old guy, I can put an extra $1,000 a year in a catch up. So I can do $8,200. But yeah, and it can grow tax free. And when you use the money and down the road, it's taken out and you don't pay taxes on it. So there's not it looked like a great program. So. Yeah,
no, they are, they're definitely, it's a nice perk to have. So, and that's generally something if I'm looking at a tax planning client and they don't have something like that, either a spouse doesn't have it through work or, whatever, well, that's typically something we'll take a look at.
Thank you.
So. Okay. Anyone else? Did I put you to sleep? I know taxes can be a little dry sometimes, but and as always, if you guys have any questions on anything we touched on here or just want to consult, I'm more than happy to do that. Even if it's for your clients, I'll just throw it out there. If you run across some kind of tax issue your client's concerned about, you can always drop me a line and ask a question. I'm happy to tackle that for you.
Okay. Well, thank you, Rich. Is there any possibility you could put your information on the chat box for people who want your information?
Yeah.
Thank you.
Oops. Okay. Hopefully I spelled that right. Yeah, that, yeah. So again, if you want to draw me an email, quick phone call, I I'll do that for my realtor clients. And, you know, when I do these presentations, I'm more than happy to help with that.
Thank you so much. And before we go, are we sure no more questions from anybody?
Yeah.
It's
I mean,
not.
again, a lot of times it's tough, and I do say this a lot. It depends on the individual situation.
Yeah,
It just does. The tax code's so complex that it really depends on situations in a lot of cases. But again, if you do run into an individual situation you have concerns about or questions about, just let me know.
perfect. Well, thank you so much, Rich. I appreciate it. Thank you, Virginia, for helping me out. And thank you, everyone, for attending.
Thanks for the opportunity.
Thanks again.
Take care. Thank you.